Let's see what to consider before putting on iron condors. Let's go to the next slide. So yesterday we explored the optimization of wing width and buying power requirements using neutral strategies like the strangle and iron condor. Following this study, we received inquiries on how to easily demonstrate the advantages of widening wing widths compared to narrow wings with present lower risk, which present lower risk for novice and limited account sized traders. So in response, we compiled statistics to highlight additional reasons behind all that discussion that we had yesterday.
Okay.
It's important to mention that when setting up an iron condor, we have multiple choices, such as selecting the strikes to sell, the number of contracts to use, and the width of the wings. Let's take a look. Let's break it down. Typical for us, we go 45 days to expiration. We manage at 21 days, even though it's an iron condor. We use 10 years of data, and we looked at varying widths, three strikes wide, 5 strikes wide, 10. Oh, there's your bond.
Bonds 28. Look at you.
3, 5, 10, and 13 strikes wide. We compared the win rate, the CVAR, the buying power, the return on capital, and the cumulative performance of the average P&L. We basically broke it all down.
Mm-hmm.
So what to consider before executing an iron condor? What Tony and I like to do is we're kind of middle of the road iron condor players. What that means is we definitely don't do them too tight, and we definitely don't do them too crazy wide. So like we're kind of in the middle somewhere. So if I had to say, what are we? We're probably the 5 to 10 range.
5 would be pretty tight. I think we're more the $10 range, but sure.
Okay,
I mean, I think a lot of the NASDAQ stocks that we end up trading are higher price stocks, and that's why you go to a $10 wide.
Okay, let's go to the next slide. Okay, so say we're 5 or 10.
Yep.
And
Yep.
we kind of don't do the, I mean, we're mostly strangles. We don't do the 13 delta wide. We rarely do the 3 delta wide wings.
Right.
And the 20 deltas for the short strike is probably pretty good for us, 20, 25. So the wider the wings, the more closely the performance mimics the same delta strangle. The tighter the wings, the less the win rate, the less premium collected, also the less buying power used. And this is all like something that shouldn't surprise you, but you can see where we are here at those 10 delta wings. We're kind of right in that, 61 versus 71. And you can see our numbers are about half of, what we would take in premium wise. And the buying power is, I don't know, 1/4, about 25%. We usually figure back of the envelope, we say between 20 and 25%. That's the back of the envelope. If you're only taking in like if you're doing 3 deltas wise, you're using $300 for 6,000 in a strangle, so it's 20 to 1. That's only 5%. That's way too narrow.
Sure.
If you're doing about 20 to 25%, which would be, which is something like around the 10 delta, that's okay. To me, that makes a lot more sense. And that's where we like to be on most of our defined risk trades. So we don't want to be, it's not like 1/20th. We want to use maybe 1/4, 1/5. That's our back of the envelope, kind of an idea that we're kind of collecting enough premium. Let's go to the next slide. I also don't like that 52% win rate, in the cheapies.
Right. You'd rather be in the 60s, right?
The cumulative P&L over time provides an overview of how the varying wing widths perform over the same period using the Iron Condor strategy. And as you can see here, there's two of those lines below 0. And there's no real reason using the S&Ps and managing in 21 days over a 10-year period why you would ever want to do something that ends up to be as a negative return. It's below the 0 line. The 10 delta, 13 delta have a positive return. That's your answer. I mean, you don't have to go any further than that. This is, sure. I mean, some of those are pretty consistently below the 0 line. And the other ones are pretty consistently above. Except if you take, the pandemic really dragged down the averages. But still, the wider you go, the better off you've been. Let's go next slide. And those are cumulative P&Ls. Okay, even though the tight iron condors exhibit a lower risk profile, as shown by the CVAR and the worst case loss metrics, they may lead to negative returns on buying power and capital deployed over time. There's clearly, okay, now again, these are cumulative over time. So it's a little different than the way you would really look at anything in a more traditional. You don't look necessarily cumulative over time, but still, you can see the 3 and 5, and the other ones were just small positive, and the strangle was the most positive. That's why we like undefined risk the best. But we tend to stay in that 10 delta. Maybe we even go further. Maybe go a little bit higher. But based on this study, the worst losses I feel like they're in line with everything else, and the C bar I feel like is in line. I don't think none of those numbers are crazy. I think they're just what you would expect. But I think the takeaway from the segment is you want to stay away from delta widths and from the narrow width iron condors where the long-term cumulative P&L is a negative number. I know it's attractive to not have to put up much money. I know it's attractive to have the low CVAR and the small buying power. It doesn't work. If you hit one out, great. But so although tight iron condors require less buying power, their low average P&L, their negative return on capital, and their win rates just don't justify consistent use. You want to do it on a one-off basis? Go ahead. But consistently, if we increase the wings, the trades more closely replicate the performance of a strangle while using much less buying power than a strangle. So is it exactly? No, it's not. You pay for the right to define your risk. You pay for the right to limit your risk. You pay for the right to use less capital. It's expensive, but